Hey everyone, welcome back to Outside the Dollar. I'm Elena Reyes. The federal government just posted one of its largest monthly deficits in years, and that number doesn't exist in a vacuum. It's tied directly to what happened in the bond market this week, where long-term Treasury yields jumped to levels we haven't seen since 2007. And when borrowing costs move like that, it ripples into mortgages, business loans, and into how gold and silver are trading right now. Gold's had a strong month. Silver's had an even stronger one. We'll dig into what's actually driving that and whether the bullish case holds up. But here's the number I want you to hold on to until later in the episode. Total federal debt just crossed $40 trillion. We're going to trace exactly how this month's deficit connects to that milestone and what it means once we get to the bond market. For anyone building a portfolio or just trying to protect what they've saved, this is a week worth paying attention to. So the story starts with the deficit number that came out this month and why it matters more than the headline suggests. $432 billion. That's what the U.S. government spent more than it collected in July alone. CNBC reported this Wednesday that it's the largest monthly shortfall since March of 2021. Let's sit with that for a second. 1 month, $432 billion. And it's not a one-off. CNBC's reporting shows the running total for the fiscal year is now near $1.8 trillion, with 2 months still left on the calendar. So where does that money actually come from? The Treasury doesn't print cash to cover a gap like that. It borrows. It sells bonds, notes, bills, and investors, pension funds, banks, foreign governments, buy that debt. In return, the government promises to pay them back with interest. The mechanical piece worth understanding is this. When you need to sell more debt, you need more buyers. And buyers asked to absorb a bigger supply of anything usually want a better price for taking it on. With bonds, a better price means a higher yield. The important thing to understand is yield isn't just a number on a screen. It's the interest rate the government pays on debt outstanding. CNBC's coverage of July's numbers pointed to interest costs as one of the 2 big drivers of the shortfall, sitting right alongside Medicare spending. Picture a household putting groceries on a credit card every month without fail. At some point, the card company doesn't just leave the rate where it is. They look at the balance and adjust. That's roughly the position the federal government is in. More issuance, more debt sitting out there waiting for buyers. So if buyers start asking for a higher price to hold all that new debt, where would we actually see that show up first? Building on that deficit number, here's where the bond market picked it up. Tuesday, the 30-year Treasury yield touched 5.234%, the highest level since 2007. Morningstar's Jamie Chisholm reported it as part of a global bond sell-off, not a U.S.-only story. Think about what 2007 means. That's before the financial crisis, before 2 rounds of quantitative easing, before a decade of near-zero rates. We're back there on the long bond. So why now? A couple forces are moving together. Inflation worries are one. Bond buyers want compensation if prices keep climbing. The other is supply. Chisholm's piece ties the move directly to concerns about government budget deficits and the sheer volume of new debt hitting the market. More treasuries issued means more competition for buyers, and buyers demand a higher price for showing up. That's the same mechanism from July's deficit number, just showing up in the pricing. Okay, but what does that actually look like in a household budget? The 30-year yield doesn't set mortgage rates directly, but it's the benchmark they track. Business loans, project financing, anything long duration gets priced off this curve. Move the long bond from 4% to 5+, and that's real money on a 30-year mortgage, hundreds of dollars a month on a typical loan. And it's not just households. The federal government refinances its own debt at these rates too. Every maturing bond gets replaced at whatever the market charges today, 5% plus, not the 2% it was paying back in 2020. So this sell-off isn't some isolated bond market story happening off to the side. It's the pressure from July's deficit showing up as a price tag on borrowing for the government, for businesses, for anyone with a variable rate loan. Total federal debt just crossed $40 trillion, and interest costs are now competing with Medicare for second place in the federal budget. What happens when a debt that size gets refinanced at these levels? Follow that deficit number all the way to where it lands. The national debt just crossed $40 trillion. Back in January 2017, it sat around $19.95 trillion. The balance doubled in under a decade. So where does the borrowing actually go? Federal interest costs now run close to $1.1 trillion a year. CNBC's reporting on the July deficit points to that same interest bill, and through 10 months of this fiscal year, it's overtaken Medicare as the second largest line in the budget, right behind Social Security. Sit with that. We're paying more to bondholders than we spend covering Medicare for over 60 million seniors. The Fed held its target range at 3.50 to 3.75% in July. Three policymakers actually wanted another quarter-point hike. Inflation risk hasn't left the room. So here's the bind. Cut rates to ease the debt load, and you risk waking inflation back up. Hold rates to keep inflation down, and a $40 trillion balance sheet gets pricier to carry every single quarter. What does that mean on the government's own books? Roughly $400 billion in extra annual interest for every percentage point added to that pile. There's no clean exit, just trade-offs stacked on trade-offs. Treasury clearly feels that weight. On August 19th, they raised the cap on their liquidity support bond buybacks from $2 billion up to at least $4 billion per operation for 10 to 30-year paper, starting September 9th. And markets didn't wait around to react. So here's the mechanical piece that actually moved markets last week. On August 19th, Treasury quietly doubled its liquidity support buyback ceiling for 10 to 30-year debt from $2 billion to at least $4 billion per operation, starting September 9th. Why does that matter? Because it's Treasury buying back its own longer bonds to smooth out a market that's gotten choppy under all that new supply we just talked about. Shifting to metals directly. Gold's up over 10% over the past month, but silver actually beat it, gaining over 16%. That's according to a Yahoo Finance piece from earlier this week. Silver's move isn't just riding gold's coattails. Yahoo Finance noted mine output hasn't kept pace with demand from solar and EV manufacturers, and above-ground stockpiles are shrinking. Think of gold as the wealth preservation trade and silver as the one with an industrial anchor. Now, here's what also caught my attention this week. Jeff Currie, one of the most watched commodities strategists, flipped from bearish to bullish on gold. CNBC reported Monday that Currie pointed to emerging market central banks diversifying their reserves as the driver. He told CNBC those central banks are building gold reserves for the long term. A strategist changing his mind after a strong month counts for something. Central banks buying gold is a demand factor. It shows who's in the market this month. It says nothing about next month's price. And one strong month guarantees exactly nothing about month 13. Currie himself told CNBC the volatility continues, just with higher highs and lower lows. So what does that mean for the person listening with a typical 401k? Most portfolios sit almost entirely in stocks, bonds, and cash, dollar-denominated assets, essentially one bet dressed up as three. Given everything we've covered this episode, the deficit, the yields, the debt, ask yourself one question this week. If your savings sit almost entirely in stocks, bonds, and dollars, does that still count as diversified, or does it just feel that way? If that question is sticking with you, don't just sit with it. Text $dollar to 43343 and we'll send you a free investor kit that walks through how physical gold and silver actually fit alongside those stocks, bonds, and cash. No pressure, just information you can read on your own time. So let's connect the pieces from today. Bigger deficits mean more borrowing. More borrowing pressures yields higher. Higher yields raise the government's own interest bill, and that bill limits how far the Fed can cut without stoking inflation again. That's the chain that's pulled gold and silver back into the conversation this week. Now, stocks, bonds, and cash all still serve a purpose in a portfolio, but physical gold and silver sit outside all three, outside dollar-denominated accounts. If most of your savings depend on stocks, bonds, and the dollar, is it worth learning about an asset that depends on none of them? To learn more about owning physical precious metals or adding gold and silver to an IRA, text dollar to 43343. Thanks for listening.